Good morning and welcome to session 4 of Simple Steps for Starting Your New Business. This webinar is being recorded. You'll be sent a link to the recording. It will also have a copy of the presentation, so you can take whatever notes you like, but you will have the slides. If you have a question, we'd like for you to write it down as you have that question in the chat, and we will get to all the questions at the end of the presentation. The next slide will tell us that this is the financial matters component of our webinar series. So financial matters, this is what you need and you've been waiting for. So let's go to the next one, and I will just introduce briefly our panel, Jaspreet Chowan, Mike Moore, and Bob Garcia, all experienced business people and all great with numbers. Next, here we are in the process. Hopefully you have secured your personal mentor. If not, we will continue to tell you that this is the secret to getting your business plan out there and succeeding. But you can see where we are. Here we are at session 4. You've made the go or no go decision. You've decided to go, and you're working on building your business plan. And next week, we'll talk about funding sources. So let's go to the next one. You had some homework last week. We're ever ready to work with you on that, to help you with that. You were continuing to work on your feasibility plan, and you were filling in the comparison for selected target markets worksheet. And those worksheets are still available if you're just getting started. Let's go to the next one here. And our agenda for today: financial planning, financial projections, forecasting sales, pricing fundamentals, understanding financial statements, and record keeping. Now, one of the exciting features is we're going to preview the financial projections worksheet briefly for you today. Let's go to the next one. And I'm just going to address this, and then I think this is where I turn it over after this to my esteemed colleague, Jaspreet. Financial planning is essential because there comes a time when you need to match your business concept with your personal income goals. They need to be in sync. You'll gain a better understanding of your financial risks and rewards of entrepreneurship. You'll also figure out how much money you need to start and run your business. Vital information. You'll identify development and startup costs, costs for ongoing operations, those expenses, and the funds you need to finance your business. This information will help you to create a plan to help guide your future business decisions and to monitor your results. And finally, it will enable you to communicate with stakeholders who are your investors, your lenders, your employees about the business's finances. So we'll move on. And maybe this is also mine. Is that true? Financial plan is your forecast of sales, the costs, the profits, the assets for the first year, and even more after startup. You use your financial plan to predict how successful your new business might be and understand where your money will be allocated and where it'll come from. And it'll help you to examine the feasibility of your numbers and organize your finances. So the 3 things that a financial plan are: it's a modeling tool that helps you evaluate variable factors. Second, it's a benchmark for tracking your progress. And third, it is a blueprint to help you adjust and achieve your goals. Now I see Jaspreet's picture. I just need to scroll down. Jaspreet, all yours.
Thank you, Tom, and good morning, everybody. So today we are talking about financial planning for your business. So this is, where we have lots of projection templates, a lot of forms that we can use for our business. And some of the forms, some of the concerns when we see spreadsheets, we have that they are so complicated looking. And we sometimes believe that it's hard for me to understand them and to, be able to complete the worksheets. So this is where we're going to be giving you lots of help, lots of information that they are not hard to understand. And they may look overwhelming, but with simple knowledge, with the just like a, small planning, especially when you're in the business already, you will see it makes sense when you start doing the business projection models. And the things happen in business. That's where a lot of businesses, they don't plan to fail, but if they don't have a plan, like a proper planning for their business, then they often fail. So let's go to next one. Okay, so these are the 6 main worksheets that you as a new business owner or existing business owners should know. Okay, so startup funds. When you're starting your business, you want to know how much it's going to cost you to start your business. Salaries, wages, your fixed operating expenses, projected sales forecast, and your cash receipts and disbursements. Okay, let's go to the next one. So we'll be explaining more in details all these spreadsheets. Okay. So the first one, let's talk about the template that help you like assist you like how much money you're going to be needing to start your business. So this is the first spreadsheet that you could use. So we can see on the left side, it has some columns where you can put all the things that you're going to be needing for your business, such as you maybe need some assets, start your business. Maybe you need some land, you need a building, you need to have that building improved. Maybe you have a restaurant that you're trying to, establish or open. You need some equipments, you need furniture, you need some vehicles for food delivery or some other things, So how much fixed assets you need, you have that total over there. And then operating expenses, that are your ongoing expenses. So if you look at the operating capital, you can also see, you can also use these, the titles and see if you, as a new business owner, if you're going to needing any of these things, right? So you can see these has prepaid insurance premium, inventory that you're gonna merchandise, right, that you're gonna be selling, and legal accounting fees, your rent deposits, if you're renting a place, your supplies, advertising, promotion, your license, all those expenses that, this is maybe the prepaid for next 12 months, right? So so total operating expenses that you're going to be needing is 41,800 plus the fixed assets that you needing. So total required funds are 213,000. Okay, so this is where we'll be talking more on details. The next slide is going to be where we go more in detail. Okay, so this is where I want to pass this to Bob Garcia, and he's going to give us a lot of details how we do these templates. Okay, so thank you, Bob. And yes, so let's.
Thanks, Jaspreet. What I'm going to do is demonstrate the SCORE financial projection template. And this template, it's just a demonstration. It's not designed to. It's only designed to show you how it works, not to reflect a real business. Can everybody see that? Hopefully you can. Okay.
Yes.
So great. So we're going to go to the starting point. Let me go to directions. Okay. This is the very first page under directions. And what you want to do is you do want to put your company name in the starting month. And am I able to print on this? Yes. Okay. So we got it, Bob's shop. How's that? And I'm going to start in the month of March, and this will track through the entire program, and it's 2023. The data here is you can change this enter new data, and then adjust, in this particular case, the interest rates, okay? So the starting point is going to start with salaries, I'm sorry, your opening cost of a new business. And most of you aren't going to buy land, but you may want to leasehold improvements here. And as Jaspreet was talking about, you just enter the amounts of what you think you're going to need. You know, another, I'm sticking in there just another $5,000. And again, these are just numbers. And you can see it automatically populates to total fixed assets of 30,000. Then the operating capital, you can just stick in whatever you think you'll need. And I'm just sticking in numbers here. You're always going to have legal and accounting. And I'm just making these up. Rent deposits, you're going to probably need first and last. So let's say rent's 2,500. Oops, not that much. Utility deposits, supplies, advertising promotion for a startup business, other startup costs. I'm just putting in, making this up, and working capital. This is going to change for all of you, and we'll make the adjustment depending on what your cash flow dictates. And so I'm going to put in $5,000 here as cash flow here. And so total required funds to open the doors is $82,000. And where are you going to get that? Well, again, and you've probably heard many times that, I mean, if you're going to borrow the money, nobody's going to finance you 100%. You have to have some equity into it. And let's say you have $10,000 that you're going to put into it outside, and you're going to borrow the rest. Okay, this template shows that you've got $10,000 to contribute. You need $72,000 to get the doors open, and so you're going to get a commercial loan for $72,000. And this number then, total funding needed, should be 0. They've got you at 9%. You can change that, or you can leave it at 9%. That's a little bit high, and they've got you for 84 months. And again, you can change that if you want, and you change it by going up here and just let's say 60 months, and you can just enter it. And that's the way you change the interest rate. Let's give this at 6%. See if I can know how to do that. Okay, so we're at 7% for 60 months, and that's going to give you your payments. All right, let's go to payroll. And every place you get a loan, you've got to pay yourself. So you got one employee, that's you. How much do you want to pay yourself? Let's say you want to pay yourself $25 an hour. You're going to work 40 hours a week. That's a joke, we know, because as the owner, you will work longer hours, but when you need to put something in there, you're going to have one full-time employee at $20 an hour, and he or she is going to work 40 hours, and then you're going to have, let's say, one part-time employee at $20, and they're going to work 20 hours. Okay, and you see how it all populates? So your payroll per month is $9,533. This is what you got to pay your employees. Plus, what the beauty of this template is that it automatically calculates for you your Social Security, your Medicare, your federal unemployment tax, state unemployment tax. And so in addition to the $9,533, after you pay the taxes for your employees, your employee, the amount that you have to pay per month just to pay salaries is $10,337. And it takes it 2 years 2 and 3. As you can see, it gives you a growth rate of 20% the first year and a growth rate of 30% the following year. Those are a little high, but again, you can change them just by going, clicking on the 20% and going up to the top and changing it. I have my people I mentor, I don't give them any growth rate at all to make it more realistic. Or if anything, it's minimum 5%. And so this is what the payroll is for the second year and the third year. Okay. So then we can take this to your sales forecast. Okay. And so you have the product. I don't know what you want to call it. Unit 1. Sale price per unit. Let's say it's $400, and I'm just going off what I used to sell, and the cost per unit is $300. So your profit per unit is $100. Okay. And how many units are you going to sell? I'm going to sell, I don't know, 100 units in March. And you see for March, it automatically calculates, you put 100 units sold. That means total sales of $40,000, cost of goods sold of 30, your total profit margin is $10,000. Now, this only has a limited number of units that you can sell. So you need to take your 5 or 6 biggest products with the biggest margins, and you can put unit 2 here. It may be a different type of product, and it could sell for $200, and the cost would be $100. You know, just marking this up, and so you can see that how it works. And so here you're going to sell, instead of 100, you'll sell 50 units of unit 2, and then excuse me. And it automatically calculates for you, and depending on what your top products are. And so the 2 units for the month of March, I'm going to sell 150 units. I'm going to have sales of 50,000, cost of goods sold at 35. My profit margin is 15,000. And you'll do this for every month at what you think. For me, I was in retail. I sold microwave ovens, and this is back in the 80s, and it varied. Depending on sales, it varied month by month, and you have to find out what your business cycle is. Ideally, from the days you open the door, it just goes straight up. You know, you increase by a certain percentage every month, and it just continues until you saturate your market. For me, in retail, my big months were obviously the holidays. November, December, and January is where I made all my money, and I actually lost money during the summer months, and the rest of the months I tried to break even. And so you will need to do this month by month, just depending on what you think you can do, and what your business cycle is. And again, it calculates everything, and it'll carry it forward all the way to the end. This is the way you move things down here, and you can see the totals are right here, and it gives you your percentages. Okay. So that's just an example of that. And now your sales forecast take you out to years 1 and 3, the second year and the third year. And it gives you automatic increases. Here's your second year and your third year. And there you have your totals. Additional inputs. This is a little bit more tricky. This talks about if in fact you're a business to business type organization, you'll probably extend credit to people, and you need to know what the industry averages is in your industry. If in fact the industry average is that you extend credit 30 to your other businesses, and you're able to collect 30% of your receivables within 30 days, you would put the 30 days up here. And then 30% between 30 and 60, and 40% after 60 days. One thing you need to know, and we'll discuss this in next week's session, is that you probably, if you ever apply for financing, you'll probably have to prepare an aging of accounts receivable. And all that does is means that you will list the people who owe you money and how quickly and how when they owe you. Anything over 90 days, they'll discount. They'll say if it's older than 90 days, you're not going to collect it. The exception is if you're dealing with federal or state or some sort of institution like a unified school district. They're notoriously slow, so that would be it. Anyway, you have 100% here. And as you can see, this is what you would put, and then it calculates all of this for you. And you would put this information here. There is an assumption that you have a line of credit at 8%, and it'll cover any deficits that you may have, and you'll see this in your cash flow later on. Operating expenses, okay. So for each month, how much is your advertising going to be? You can stick in the amounts here. Commissions, fees, contract, insurance, as you can see. Legal and professional, I always stick something in there. You never know when you're going to need to do that. License, office expense. I was always surprised when I operated my business how this was always much higher than I ever anticipated. Rent, I think we said rent was $5,000, so it's $2,500 a month. Pretty cheap rent. If you're going to lease any equipment like a copy machine, which is not unusual, it's just stick it in there. Supplies, utilities, miscellaneous, it's always miscellaneous. My monthly expenses, not including payroll, my monthly expenses are $7,400. Okay. This automatically calculates depreciation for any equipment that you may have financed. This automatically calculates the principal amount of your commercial loan. The interest will show up on your P&L statement. So total operating expenses at $8,165. Not too bad. And then you need to carry this forward each month. Okay, you just carry it forward, and you can, for those of you who know how to use Excel, you can just automatically extend that over. I won't do that now. And then it carries this for years, the second year and the third year. Okay, very simple. So then this is your cash flow, and this is what we'll talk about. Is this is the way you pay your bills. Your beginning balance, remember you contributed $5,000. In your first month, you sold $15,000 worth of product, unit 1 and unit 2. Okay, and so the inflows or what you sold is taken right here. And then your expenses, operating expenses for the month of March, and then your payroll, don't forget your payroll, now we're including this, and your loan payments are right here. So you for the month of March, your bills, everything is $19,129. And they take this amount of $19,129 and they subtract it from your inflows plus beginning cash. And you have $871 left over. Okay. And you take that $871 and you take it to April, and this automatically does this for you, and it takes it month to month. And it'll carry it forward. Now this line of credit, operating balance, you see the negatives here? You are having to draw from your line of credit. And this will determine whether you have enough cash or not in the beginning to pay your bills. And this will take it forward. And obviously you don't. And again, for this is just a demonstration. I'm not going to complete the whole thing. But it demonstrates to you whether you have enough cash. And we'll talk about this in later slides. Cash flow is what pays the bills. Profit and loss just tells you if you're profitable or losing money in a given month. It also develops an income statement by month, and you can total this for the end of the year. And again, not all of the months are filled in, so, but it gives you an idea how it'll automatically do this for you. And if we totaled it, you wouldn't be losing 120,000, but this would show you how to do that. Let's see. And this is the income statement for this the second and third year. It prepares that. It gives you a balance sheet. This is very important. It gives you a balance sheet. It automatically produces it for you. Once you get past the operating expenses, everything else is calculated for you. And so this is the balance sheet, and it'll give you assets and liabilities. And this is very, very important. And then it gives you a break even, and we'll talk about break even in a minute. Break even is important because it will determine how much working capital you will need to start your business. It is absolutely imperative. And most startups run short of working capital because you either miscalculate your expenses or you miscalculate how much your revenue is going to you're going to earn. Financial ratios, and I'll talk about financial ratios in a minute, and the importance of understanding liquidity ratios, inventory turnover ratios, accounts receivable ratios, debt to worth ratios, and how bankers look at them. And we'll talk more about that in next week's session about how to obtain financing, what questions bankers will ask, and if you have the answers ready, it's more impressive and you're more likely to get what you need. And this is the diagnostic tools, and this tells you exactly what these assumptions are. Gross profit margin to sales, gross margins percentage seems reasonable. Owner's compensation seems established, and it gives you all of this information, which is very, very valuable, especially in a startup. And this is the calculator that you can use, and your mentor will walk you through this. It's important to realize that you don't need to know all of this. Your mentor shall walk you through it. This is your depreciation. You're able to use this depreciation, especially for your taxes, on any equipment that you may have. And so this is a very, very quick demonstration on how the template works and how really informative it is and how you can use it. And I encourage many of the people that I mentored is to quickly get into this. Everybody has a good idea, but can you put dollars to that idea? You know, what are your expenses? And for me personally, I always did the expenses first because they're more easily to calculate. If I rent for example, I know if I'm going to rent a 5,000 square foot building at $1 square foot, that's $5,000. If I need to know what insurance premiums are, I can call up an insurance agent and say, I'm going to open a business. You know, what is work going to cost me for my 5 hourly employees? How much liability insurance should I have, et cetera, et cetera. You can get these numbers and list them. And then when I started my business, I had a $6,000 a month bill that I had to pay for. Could I sell enough units, enough product to cover that? Could I get my gross margin above $6,000? And that's even after paying for me. I mean, not paying for me. I mean, and you need to add that on. Remember, in this demonstration, it was a $10,000 bill with payroll and expenses. Can your gross profit margin be above $10,000 for you to do that, to be profitable? So that's my demonstration. I'm sure you're going to have a lot of questions. Your mentor will be able to take you through this, and I'll be happy to answer anything later on. Right now, I'm going to turn this over to Jaspreet. Thank you, Jaspreet.
Thank you, Bob. And that was an awesome illustration, like how the spreadsheet, they are interconnected with each other. And just like having simple knowledge, we can start plugging in numbers and, just play and try to, see if it makes sense for us, for our business. Okay, so let's go to these are the 5 elements that comprise financial plan, the start of funding, the worksheet that we talked about, salaries, wages, fixed operating expenses, projected sales forecasting, and your accounts payables and receivables. So let's go to the next one. Okay, so some of the things that Bob already talked about, some of the factors to consider as you calculate your required startup funds, how much money you're gonna be needing, and what it will be used for, and what is the source of the the money that you're gonna be needing. Is it your money? How much you're gonna be investing from your pocket? And it's gonna be loans, and how much if you have a business partner, how much they're financing, and what other sources of the capital that you need are available. Next one. So salaries, wages, and fixed operating expenses, those are some of the worksheets that Bob talked about. The salaries, wages, that includes your your payroll and your employees' payroll. And like Bob already explained, it just depends on your business, how many employees you have, how much you're going to be paying per hour. So you can do some simple calculation, and you will see that it also calculates your taxes, the payroll taxes, so you don't have to worry about those. And then adding some of the mandatory, those of course, the payroll taxes that are, that are required, the federal, state, and local taxes that you will pay with your payroll. And then some of the 30%, the wages, those are like fringes, the benefits, the incentives that you want to pay yourself or your employees, like some pension plans or some kind of health insurance or life insurance. So those you can add like 30% of with your payroll. So that's extra 30%. So fixed operating expenses, so those are the expenses that you're going to be utilizing, or you're going to be using your spreadsheet and and see what type of expenses you have, how much it's going to be costing you. Some of the direct cost, or the fixed expenses are insurance, your rent, utilities, sales, commissions, advertising, taxes, and licenses. Remember, these are the fixed expenses. So these you have to pay every month, regardless what your profit is or how much your sale is. So that's why you want to, make sure that you are ready, whatever business that you're starting. So because you are aware how much it's going to cost you every month. Okay, let's go to the next screen, 16. Okay, so what unit categories make sense for your business? So this is where you figure out what you're selling. Are you, you're selling products, you're selling services, how you're going to be setting the price for the service that you're selling, consulting, how much per hour, or fixed price, or combination, maybe you're selling the product and the service. So how much you're gonna put it together. Determine what makes up your unit of sale. So that is again talking about, what you're selling, you're gonna include all the cost or all the expenses that that you had to pay to sell that unit. Okay, determine your direct cost per units. So those are all the direct cost, your utilities, your insurance, your your rent. So those are all the direct cost, and you just need to know how you're going to calculate, how much the price per unit you're going to be selling it. So if it makes sense. Okay. So now I have one more, let's go next one. Okay, so sales unit data sources. So how do we, when we are starting a business, we sometimes don't know how to price our product or services. So that's where you can use some of the sources that are available, especially nowadays with the, with the internet availability, with so many sources we have available. Sales unit category or grouping. So that's where you can, find out your product, service, package, or volume, customer type, and your unit cost and price. How do you, build up from sources, your subcontract, your competition. So taking some of the information from your competition, I think it's great help to, help you to see what you should be selling, at what price you should be selling your product services. Estimate from market, your competition, and back end number to make business profitable. Again, you are in the business to make money. So this is where you want to do a lot of clear analysis on your cost, how much it cost you, and what you're going to be charging other people, your customers. So you have at the end that you are making some money. Okay. So now I would have the next from here, I would have, Michael Moore to take care from these slides. Thank you everybody for your time.
Thank you, Jaspreet, and good morning, everyone. We're going to look at an example or consider the elements of this company called Planet Earth. They've got 3 categories of sale. They are doing their own website, they're using Shopify, and they're also selling on Amazon. A nice combination of getting your product out there. Next slide, please. So it's important to know in the market price, number one, what are your competitors charging for the same product? You want to make sure that you are relatively close to that, so that, or rather you should view that as a goal to have your price so that, you're not underselling, you're not overselling. But there is a wrinkle to this. Are you going to approach the market from the standpoint of offering a premium product? In other words, a few more bells and whistles, maybe additional sales and service, service along with it, or contracts, this sort of thing. Or are you going to be a discounter? You're going to take your product, here it is, a bare bones price, or are you just going to meet the market and have it similar to your competition's price? The elements of pricing, which I think we just touched on a little bit, are premium price, if you have a superior product or you're going to add more to the product. The consumer reaction, if people are excited about your product, you can probably have some flexibility in your pricing there. What's the competition doing? Again, not too far above and not too far below is where you want to be. And what the cost of your product is. And finally, are you going to grant credit terms and discounts? That's going to be important to figuring out, are you going to make money or not? Next slide, please. So that really kind of talks a little bit in the last slide about sales channels. If you're selling directly to consumers and retailers, you'll need to make sure that the retailers aren't being charged the same amount that you're charging people directly. They need to make a little money on your product too, otherwise they're not going to want to carry it. The markup on cost simply means you figure out what's it cost me, how much do I want to mark it up. Again, pay attention to the competition in the market. Bundling is a strategy where you might, and you probably hear this with cable all the time, you buy the main service. Oh, and if you buy this service and this service, we can give you a better price on all of it. That's bundling. And there might be an opportunity for you in that respect. And finally, you want to focus on your target market. Who is your target market? Who are the people most likely to be buying your product? You're going to be focusing on maybe income levels, age levels, locations. Who's going to buy your product? And again, study your competition. See what they're doing, see what's being successful for them, and that's going to give you an important clue as to how you ought to proceed. Next slide, please. Continuing that line, you might want to consider promotional pricing. Typically, it's something where, hey, we've just opened, and for the next month, we're going to be selling this product at X price, as an example. Very similar to introductory pricing when you're trying to get good long-term relationships. Come on in, get started with us, and for the first month, this is all it's going to cost. After that, it'll be a market price. But the introductory pricing introduces a period of time when they are feeling favorable about your pricing and your product, and you develop the customer relationship. Next slide, please. Okay, in setting your initial prices, which is what all this is about, you've got to consider, okay, what does this product cost me to put out there? Typically referred to as cost of goods sold in your projections and on financial statements. When you're pricing it, consider, again, standard industry practices. What's your competition doing? Again, don't try to be too high or too low in comparison to those prices. What do they charge? Are you going to match it? You're going to beat it or charge more? Next slide, please. You've got to keep an eye on your customer demand. If you open and your product and you sell out the first day, well, that tells you something about your market. Your product is well received and people really want it. You can adjust your pricing based on that because after all, and as has been mentioned before, you're in this business to make money, not to give money away. You want to see how are your sales doing versus your competition. And you want to make sure that you're providing a value commensurate with the price. This is very important when you go to premium pricing. You want to make sure that you're charging higher price and your customers feel they're getting something extra for it. Otherwise, that won't be a good strategy. And whenever you're looking at it and you're thinking, well, I really need to make more money, I think I'm going to increase my prices. Try looking at reducing your costs first. Maybe you can find a better supplier. Maybe you can find changes to the product that you can make, which reduce its cost. Try that first. If that fails, okay, consider price increases. But again, pay attention to what your competition is doing and the sales channel you're using. Next slide, please. A word of caution. It's tempting to say, well, they're selling it for 10, I'm going to sell it for 750, and I'm going to clean up in this market. But when you sell it too low, not only are you not making as much money, but you may encourage your competitors to do the same. Then you don't stand out anymore. It's called a price war. Back in ancient times, we used to see price wars between gas stations. That's been a long time ago. But ultimately, it just leads to you're heading in a downward spiral. And it's well said at the end of the slide that this is a war you can't win. Don't start it. Next slide, please. Let's talk about a little bit about the gross profit margin. This is simply your sales price versus the direct cost of sales. The margin is very important because that is what's going to pay all the other expenses of your business. And I think I just said what's on the next slide. Next slide, please. And I think at this point, this is where I'm going to turn it over to my esteemed colleague, the microwave salesman, Bob Garcia. Take it away, Bob.
Thanks, Mike. Understanding financial statements. The income statement, cash flow statement, and the balance sheet are the financial statements you are going to need to understand to effectively manage your business. Each of them will tell you something different, but each of them are just as important. So let's talk about the income statement first. Next slide, please. The income statement determines how long it will take to reach profitability. Every month, whatever your sales are, less cost of goods sold, gives you a gross profit margin, and then less expenses and payroll. Did you make a profit or did you make a loss that particular month? And as I told you, in my business, I was only profitable 5 months out of the year. Lost 3, and the rest of the months were break even. And so what was more important than that was the cash flow statement. Did I have enough cash, especially in those break even and months that I lost money? Did I have enough cash to pay my bills? The cash flow statement will tell you if you have enough cash to pay those bills. And the balance sheet is a tool that most startup businesses do not use. But as you grow and as your inventory gets larger, as you employ more people, things like that, as you grow, a balance sheet will be a tool that you will use more and more. And it's imperative that you understand how to use it. Next slide, please. The break-even analysis is very, very important when you start up your business. That's very, very important if you expand your business, especially if you are in a new territory with a new product. What is your break-even analysis? As a startup business, the accumulated losses for your first 6 or 8 months, if you add those up, that's the amount of working capital you will need when you open the doors to carry you through until the time you become profitable. And this break-even formula here is what you should use to determine what your break-even is. It's quite simple. The template that we went through will figure this out for you automatically, but it is something that you need to understand. Next slide. The benchmarking of ratios. And again, the template will make these calculations for you, but you need to know what they mean. For example, under liquidity, your current and quick ratio. How important is that for what I call a cash and carry business versus a company that extends credit to other businesses and relies on the collection of receivables to get their money and pay their bills? One versus the other. It can be less than 1-to-1 if you're cash and carry. It needs to be sometimes 2-to-1 if you are a business-to-business type organization. Profitability, efficiency, these are the things that you will need to know to effectively manage your business. And when you apply for financing a regular conventional loan, these are the calculations that the underwriter will make to determine your ability to pay back the loan. And they make other determinations, the strength of your business to carry you through in slow times and things like that. And so if your banker knows them, this is stuff that you need to know also, and it'll help you better manage your business. Next slide. The financial statement analysis. The last thing anybody wants to do, as speaking from experience, is after working 10 or 12 hours during the day, is to go and do the book work and to make those calculations and determine what your ratios are and all of that stuff. And you know, with today's software system, as the sales are made, it's automatically inputted, but it is something that you need to be on top of, especially the first year of your business. When I opened the doors, I was on my financials daily, and then it became weekly, and then it became monthly as I became more comfortable with the ups and downs of my season. But it is something that you need to know and be prepared to put in the time to keep things updated. Next slide. And again, preparation is essential. Lenders want facts. As a banker, I can't tell you how often that as I analyze the financial statement and ask questions of the borrower, I heard the phrase, call my accountant. The accountant is not the borrower. You're my borrower. I want to know that you know what's happening in your business. And the way we talk is through the financial statement. You need to know what your financial is saying to you. You need to know how often your receivables are turning. Why are your payables late? How liquid are you? What is the debt to worth of your business? Things like this. Record keeping is essential, and you need to understand it. Next slide. Nobody does accounting manually anymore. If you do, you are a very, very small business, and if you grow, you're going to be behind the times. You need to understand. You need to buy a system that you understand. Choose a system that your accountant uses. You want them compatible, especially at the end of the year when you do your taxes. You can hire a bookkeeper, or you can do it yourself. Regardless of the bullet points on this slide, the fourth one is the most important. Training and educating yourself in accounting and understanding financial statements. It is imperative. I can't say this strongly enough. You need to know accounting. You need to have a grasp of debits and credits, assets and liabilities, especially as your business grows. Yes, you can hire it out, but if your accountant or your bookkeeper makes a mistake, the worst that could happen to them is that they would get fired. But you as the owner, you're the one that pays the fine. And so you need to understand what is happening in your business through the financial statements. Also prevents fraud. Over the 40+ years I was in banking and lending, I can't tell you how often I heard about businesses losing money through fraud. And more often than not, it was a family member, unfortunately. But it happens. So work with your accountant also, especially as you grow in the first few years. Work with your accountant when you think you're going to expand your business or buy a major piece of equipment, ask your accountant how it's going to affect your bottom line. Maybe you need to finance that growth, or can you finance it internally? You know, what do you want to amortize something, or do you want to expense it? These are the questions you need to ask your accountant, because it will affect your bottom line and your ability to pay, not only pay your bills, but to expand. Next slide. So that's what we have to offer in this particular session of Financial Matters. Our last session, funding options. For any of you that think that may need financing, we're going to talk about conventional financing and unconventional financing. We'll talk about non-bank lenders, crowdfunding, stuff like that. Very, very interesting stuff that you should know. Information is also going to be included about what questions the bankers are going to ask you, and the answers you should know and be prepared to answer. Next slide, please. Okay, so again, we've given you this link website before, score.org/startyourbusiness. Includes handouts and other materials that we've talked about. Next slide. And download the financial projection template. If you know Excel spreadsheets, this should be really easy for you. And for those of you who don't, get a mentor. We will walk you through it. The information you input, you have to come up with, but we'll show you where it goes and once it's done, we can help you analyze it and what it means for you when you start your business. Next slide. Funding sources next Thursday at 10 o'clock. And I'm looking forward to that, since Mike and I are both retired bankers, and Jess Briggs has been in business herself. So we're very excited to give you the information that we have. Next slide. Questions? Okay, Christina, do we any questions that anybody has? Or did we answer them all? We're so good.
So I just want to take a moment and thank our facilitators for today. Great presentation. And I also want to mention to everyone that attended the Simple Steps program, if we do have a certificate for you for session 5. So if you can, email me your name, and that way we can verify you attended all the webinars. And if you have a business, send me the business name, and we will get a certificate emailed over to you. I just put my email there in the chat for everyone. And if you are listening to the recording of this, you can reply back to the email that I sent for the follow-up, which everyone will receive a follow-up email today after the webinar. That includes the PowerPoint presentation linked to the recording and the financial spreadsheet that Bob reviewed. In the meantime, I don't see any questions in the chat.
Well, great. I do want to expand a little bit on when you make up your projections, you need to recognize what your market is doing, what your industry is doing. And I sound like a broken record because I say this so much to so many people. But when you're making your projections, you need to recognize, are you in a growth business, or are you in a business that's fairly saturated? My examples are the hospitality or restaurants, for example. I think that the restaurant business is saturated in Fresno. So if you're opening a restaurant, you're probably stealing a piece of a pie. You're slicing the pie a little bit thinner. And I, as a banker, would say, well, where are you getting your sales? You're probably stealing from your competition, because there's probably no new growth in most areas of Fresno. Now, if you can prove me wrong, that's part of the presentation. But if you're in the health industry, that's a growth industry. And there's probably enough revenue available for everybody, because we are aging. Baby boomers are aging, and we need assisted living facilities, memory care, things like that. And so, yeah, so determine where you're going to get your sales, and then also determine what your gross profit margins are. And then, of course, as we've said, you'll calculate your expenses in payroll and see if you can actually make it in that particular industry that you want to open your business in.
Bob, just to the contrary, on the food business is very competitive. A lot of places are closing, but I have 5 that opened the past 5 months, and they're doing very well because they have done the research and they understand their financials. The market is out there if you have the product and you have the financial availability. Funding is kind of critical. You know, the rates have gone up a little bit. I just saw some of the SBA loans come through. They are still affordable. And, you know, talk to your mentor on different types of financing. Bob's going to talk more about crowdfunding, which many of you may not have heard of, but access to capital should not be a problem for today's small business. And we're going to go through that next week. I know a lot of people struggle with the financials, Bob, but I think you pretty much illustrated that, you and Mike. You know, having sitting on a loan committee for the past 40 years, I look at a lot of loan applications, and you can see if they had it hired out or they had done it themselves. And put your footprint on your business plan and your financials, because this is a document, a working document you have to work with, not only with your accountant, but your banker. And Bob or Mike, talk a little bit about banking relationships. A lot of people just go there and make a deposit. And I know we're doing virtually everything on online, but for small businesses out there, working with me with a local regional bank and having that personal relationship of what that means. Can you talk about that for a little bit?
Certainly. That's in fact, I most recently was employed by a small regional bank here in Northern California. And I can tell you the most critical thing that you can do as a business owner is to have a relationship. And I mean, not just where you deposit, even then, you'd like to know the operations officer, the one who's in charge of that branch. You'd like to ask for a referral. You know, I'd like at some point to talk about commercial loans. They're more than happy to introduce you to a loan officer who's been assigned to that office. You'll find very receptive discussions to go on. I'd like to elaborate a little bit on that and say that, you know, we just finished talking about projections and how important they are. Nothing impresses a banker more than you showing up with, here's where I am today, here's what it's going to cost, I'm going to get going. Based on what I've learned in the market, here's what the sales are going to be like over the next several months. We expect growth 8 or 9 months out. We're going to capitalize in the Christmas season, and that's going to carry us through into the spring. They love that. They love that because it shows that you're on top of your operations. You've studied your market. You know what you can do. You've paid attention. You know where you fit in the business. So some people would say, well, why do I have to do projections? You know, I'm going to make money. Here's where I'm going to start. No, we need to see how it's going to keep going that way, because even within a year, there are cycles that are going to affect your business. We need to see in your projections that you've allowed for that or are capitalizing on opportunities that are going to come up as a result thereof. So anyway, projections are important. Have a relationship with your banker, a real relationship, somebody you know, and you know, take them golfing once in a while too. That's always nice.
I can add to that, Mike, that the recent pandemic really, I think, gave a great example of why you needed a relationship with a banker. When the EIDL loans and PPP loans came out, you had to apply for them through a bank, and everybody was overwhelmed. Those people who had a personal relationship had the cell phone number of their banker. They're the ones that got their applications processed first. And it's just a good example of why the importance of having a banking relationship. And yes, a pandemic comes along once every 100 years, but there are other reasons to have a relationship with a banker. You never know how business is going to go, whether it's a downturn or you're just exceedingly doing well. You know, the relationship is a very necessary item in your overall structure of your business. That and insurance and accountant, things like that. These are the people that will help you in your business.
All very true, Bob. And you know, you mentioned the COVID pandemic and the PPP loan programs. I can give you an example of how it worked for us, saying from the banker standpoint. We trained our people very early on. Here's the program. Here's how it's going to work. And I don't mean just the loan officers. We familiarized the tellers with it as well. So when people came in and they were saying, "Hey, I'd like to do this, but I don't know how to," oh, you want to talk to Joe Smith over there in the corner. He's got the program, and immediately we're able to set them up. A lot of people experienced what I call the 800 number syndrome. They'd go into their very big bank where they'd been banking for a while. They had no relationship. Nobody knew who really they were. Maybe.
Oops. Mike,
Well,
froze.
here's an 800 number for you to call. No, it was too complicated to just handle in a phone call like that. So we came out on top because we were able to get those people and say, "Hey, we will help you. We can help you, and we will help you." And that's what you want to hear from the bank when you're in that situation.
Right, exactly.
So for the graduation certificates, Christina, if we could just do a really quick pulse on the attendees, those that plan on starting a business, those already in business, because we'll need their name for their DBA, for their certificates. And so those two categories for those that plan on starting a business and those that are in business. And that'd be a little quick, simple survey. And probably the third one is, I'm still thinking about it. So.
Sure, let us know in the
categories.
chat if you are planning or in business, or what was the third option, Peter?
Or not now, later.
Oh, okay.
And some people in here just getting information, which is fine, you know.
Okay, we have one, it says in business. Thank you. In business, another one.
Oh, how many attendees do we have today? Do we know?
17.
Well, that's a good number.
Should be at the bottom of your screen, Mike.
Have a Q&A. Another person said in business, so majority it looks like are in business, Peter.
Well, that's awesome. That's
Yeah.
awesome. Well, we look forward to working with you. If you don't have a mentor already, please do so. We are hosting what we call Good Morning Central Valley. And it's kind of a catch-all for updates on what small businesses need to know. And that's coming up on March 7th. Is that right, Christine?
The Good Morning is going to be on March 8th.
Okay, March 8th.
Mhm.
And we'll be sure that you're invited to that. But we're going to bring updates of small businesses, what's going. We're going to do this on a quarterly basis to keep our business owners apprised of what's going on in the business community. So stay tuned to that. And thank you, everybody, for attending. And we'll see you next week. And then Jess, Bree, and Bob, and Mike, can you hang out after?